nothing trading on Thursday in response to disappointing Q4 results. Here's everything you need to know about Tesla's quarter in about 10 minutes. My name is Brian Feroldi. As of the time of this recording, I do own shares of Tesla and have for more than a decade now, a $660 billion company. So revenue this quarter was up 3% to $25.2 billion, missing Wall Street's estimate of $25.6 billion. Management does not give revenue guidance, but they have for years called for 50% average annual growth in vehicle deliveries. Earnings per share on an adjusted basis, non-GAAP, down 40% to 71 cents. That was below Wall Street's estimate. So disappointing top and bottom line results for the company. Margins continue to be abysmal and under huge pressure due to the company's cost cutting and price reduction initiatives. Gross margin, operating margin, both down huge year over year. Net margin was an eye-popping 31.5%. There's a big asterisk there that I'll get into a little bit. Free cash flow production was strong, over $2 billion. That was up year over year. Net income on a GAAP basis was almost $8 billion. Again, an asterisk there we need to talk about. That was more than double the year ago period. And the balance sheet is looking fantastic. $29 billion in cash, $4 or $5 billion in debt, but a whole bunch of that is related to vehicle financing and stuff. Digging into the numbers a little bit more, we saw that total deliveries were up 20% year over year, 20% growth in vehicle deliveries. Now, the solar business continues to be a drag, down 60% year over year. This is essentially a nothing burger for the company. This acquisition has not paid off at all for investors. Storage business, though, continues to grow quite nicely, up 30% year over year. Now, despite growing vehicle deliveries by 20%, revenue from automotive was up just 1%, showing the effect of those huge price reductions that Tesla has been passing along. Energy business was up 10%, and the service business was up 27%. So that service business is a bright spot for investors. Now, with those price reductions, the total revenue was only up 3%, and gross margin, GAAP gross margin, was down to 17.6%, down hugely year over year. Now, despite the fact that gross profit was actually down and margins were down, operating expenses were up 27% year over year. So lower gross profit, higher expenses, that's obviously going to do bad things to operating margin. Now, net income was $7.9 billion, up more than double from the year ago period on a GAAP basis. On a non-GAAP basis, though, down 40%. But from a cash perspective, cash from operations was actually up 33%. That was nice to see. CapEx was up, but free cash flow had a 45% jump. And as mentioned above, $29 billion in cash, plenty of financial liquidity. Now, why was there such a huge jump in that GAAP accounting profit? It's all due to this. The company recorded a $5.7 billion tax benefit this quarter. That is something that is not going to repeat going forward. So don't lead too much into that huge GAAP net income. Moving forward, the company actually said its tax rate is going to increase to be more in line with other components of the S&P 500. So in other words, its tax rate is going to go up. That is going to be a drag on net income moving forward. Now, turning into some news from the company, the big news this quarter was the launch of the Cybertruck, and management believes that they can produce about 125,000 of these annually. Total capacity across their platforms, it currently exceeds about 2 million vehicles. So great progress there. From a market share perspective, they continue to gain share basically everywhere at basically a 4% market share in the U.S. and Canada. So remarkable improvement here year over year. Continues to take market share. Now, their FSD program continues to go parabolic, and the number of miles that are driven with FSD continues to grow rapidly. They just launched version 12 of FSD, which is going to be some huge improvements. So it will be cool to see if they can launch this as an official product next year and really increase their take rate to customers. That will do wonderful things for gross margin and free cash flow. Now, turning to some management commentary from Elon, there was a bunch on the call. I just picked out my favorite quotes. So 90% of their vehicle buyers in 2023 were brand new to Tesla. So they are doing a great job of attracting new electric vehicle buyers. When talked about the timeline for the company's next generation vehicle, their low-cost vehicle, Elon said they hope to start production at the end of 2025. That might be optimistic if you know Elon's timelines, but that's what they are targeting right now. In terms of margins and really, in fact, demand, they were asked about margins, and Elon basically said the monthly payment is really what impacts whether people can afford their cars. So if interest rates come down, they think margins will improve and they think demand will be very strong. If interest rates don't come down, both of those things will be far more challenging. So that interest rates this is a company that is sensitive to interest rates. There's no getting around that at this point. In terms of guidance, they were asked quite frankly, do you anticipate 50% volume growth to continue moving forward? And they basically said no. They said they're in between two growth waves right now. The 3Y boom from the initial global expansion, that's coming to, it's slowing down, and their next generation platform won't really launch until 2025. Probably 2026 if we're being realistic. So in other words, don't expect torrid rates of growth this year and next, at least from a vehicle perspective. So that certainly takes some wind out of the company's sails. Turning to guidance, the 50% average annual vehicle growth, I just kept in there. It's obvious they won't be hitting that this year. It'll be interesting to see if they reiterate that in future conference calls. But for what it's worth, for next quarter, Wall Street is expecting 13% revenue growth, a 9% decline in adjusted earnings per share. For the full year, they're expecting 19% revenue growth and 18% jump in adjusted earnings per share. So Wall Street's expecting another year of revenue growth and another year of profit growth. It'll be interesting to see if they can deliver on that. How about the overall thesis here? Well, I'm going to continue to keep my eye on deliveries, margins, really focus heavily on margin. Full self-driving remains a wild card, and then free cash flow production. If I was to rate the company's moat, I would say it's stable. At worst, widening would be at best, but there's more competition now than ever. But I still think the thesis is largely on track, even if the next couple of years will be more lean than shareholders would want to see otherwise. This company continues to score very well on both mine and Brian Stoffel's investing framework. Turning to valuation, when we think about Tesla's income statement, it's positive across the board and it's sort of optimized. There's hard to say what this company's ultimate margin profile will look like. But when we think about where it is in the business growth cycle, it is in the operating leverage phase. It's been going back and forth over the last couple of years as it raises and lowers prices, and profits have moved in flux. So it's definitely somewhere in this phase. For that reason, I think the best way to value this company is by using its current multiple and maybe its forward multiples too. So we can take a look at many of the company's multiples, and we're going to do so by using the sponsor of today's video, which is a fabulous tool that we absolutely love called FinChat.io. FinChat.io. It's got a beautiful layout for figuring out how to analyze a business very, very quickly. So here is the price chart for Tesla over the last 5 years, and we can, of course, drag this and make it whatever we want. But if we look at about 5 years of data, the stock is currently down 50% from its 2021 highs, and that's before accounting for any decline that we're going to see today. So this is a stock that's going to be down about 60% or so if the current morning movement holds from its recent high. But check out what we can do with the FinChat tool. We can take a look at basically any of the company's metrics, click on them, such as gross profit, and boom, we can see a beautiful visual chart of that along with the compound annual growth rate of that metric moving forward. So this is a really, really cool tool that we really like a lot. Now, I clicked on the charting perspective, I clicked on Tesla, and I loaded in some of the company's most important valuation metrics, such as price to sales, price to gross profit, automatically calculated, price to earnings, and price to free cash flow. So these are all trailing metrics, and let's take a look at these numbers looking backwards. So price to sales, currently about 7-ish for Tesla, so quite high in absolute terms. This got down to under 2 in late 2019, currently about 7. So pretty high on a price to sales basis. How about price to gross profit? A metric I like even more than price to sales. Tesla is currently priced at 36 times gross profit. The difference between those two reflects that very low gross margin. So a very high price to gross profit. It was as low as 9 back in 2019, so it's well above that number right now. How about PE? About 67 times trailing price to earnings ratio, and about a couple hundred times price to free cash flow ratio. And what's cool is if you actually scroll down to the bottom, you can see these metrics and how they have trended over time. But those are the trailing numbers. Let's take a look at the forward numbers. So all I did was I loaded in the forward numbers to this same modeling tool. And let's take a look at those. So this is the forward price to sales. So looking forward 1 year, currently trading about 6 times forward sales. We're trading at about 60-ish times next year's earnings estimates. And we're trading at about 59 or so times forward estimates. If we keep scrolling down, though, we do have estimates going out 2 years, 3 years, and 4 years. So we actually can see these results over a longer time period. And if you look out 4 years from now, Tesla is currently trading about 4 times forward sales, so 4 years out, 33 times forward earnings, and 41 times forward PE ratio. So that is a lot of growth that is being priced into Tesla's stock today. Now, I pay for the premium version of FinChat. You can get a lot of these charts for free, but you can't get the analyst estimates. But let's take a look at those. So this is the analyst estimates for earnings per share. So this is this year and this is next year, and you can see how wide the range is between what analysts think. But if we look out to 2025, analysts are currently projecting about $5.30 in earnings per share out 2 years. So not a lot of growth this year, but they expect quite a bit of profit growth out into 2025. And if price targets are your thing, here's where price targets are. I never pay too much attention to price targets myself, but just shows you how cool this tool is. And if you're into AI, you can even ask it as an AI engine built right in that you can ask it to ask basically any question you want about Tesla, and it'll take a look at that. So thank you to FinChat for sponsoring today's video. You can actually sign up for free for FinChat and use many of these features, not all of them, using the link in the video description. So let's take a look at Tesla from another valuation perspective, the reverse discounted cash flow model. So this is a tool that we have custom built. It's just a simple Google sheet. There is a link in the video description to check it out. So Tesla is a ticker. Their trailing 12-month free cash flow is about $4.4 billion. I did a terminal growth rate of 2%. I want a return of at least 10%. And doing so, if we adjust to the current price, so this is below the starting price because the shares are down considerably today, I estimate that Wall Street is pricing in 35% growth in the company's free cash flow over the next 10 years. So if you want a 10% return, Tesla has to deliver 35% growth in the company's free cash flow moving forward. That is certainly an optimistic number. And make no mistake, even though shares are down considerably from their all-time high, a whole lot of growth is priced in to this business. So as a shareholder myself, I personally have no plans to sell. I think the next 10 years could be very fabulous for this company, but make no mistake, we could be going through a period where nothing happens for shareholders, and perhaps the stock trades sideways or even downward as the company readjusts to the more recent expectations. But it's Tesla. It's going to trade on news. It's going to trade on hype. That's just a price of being a shareholder. Hope you enjoyed this review. Please give this video a like if you did so, and I'll see you in 90 days on this one. Brian out.